Ladies and gentlemen, good day, and welcome to Q3 and 9 months FY25 earnings conference call hosted by BanswaraSyntexLimited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravindra Kumar Toshniwal, Managing Director, BanswaraSyntex. Thank you, and over to you, Mr. Toshniwal.
Thank you. Good afternoon, everyone. I welcome you all to our Quarter 3 and 9 months FY25 earnings conference call. Along with me, we have on the call our CFO, MS Kavita Gandhi, and SGA, our Investor Relations Advisors. I hope all of you have gone through the investor presentation deck that we uploaded on the exchange and our company website. So let me start with the industry landscape before moving into the Banswara financial performance. The global apparel market is estimated to be valued at $1.8 trillion in 2024 and is expected to grow at a CAGR of 4%, reaching $2.3 trillion by 2030. China remains the largest exporter with a global trade share of approximately 34%, followed by Vietnam, Bangladesh, and India. Notably, the recent challenges in Bangladesh have disrupted its supply chain and created opportunities for India's textile and apparel industry to strengthen its position. The global trade landscape is showing signs of strong recovery for India in particular. We have good tailwinds, and with the fear of a recession in the West now behind us, and the hope of a resolution to various conflicts in Russia and Ukraine and the Middle East, we do see that trade will improve. The supply chain issues that disrupted trade over the past few years are also easing. We hope this will give the industry some breathing room. At the same time, higher tariffs on Chinese goods in the U.S. may help reduce China's trade and improve India's. This shift will push trade and investments towards India. We hope this will be creating exciting opportunities for export growth. Another interesting trend we are seeing is how retailers are moving towards integrated sourcing. They're choosing to work with fully integrated suppliers who supply a complete garment package, and this is driving consolidation in the market and setting the stage for bigger and more efficient players to emerge. I'd like to give you an update regarding our garment facility in Surat. The company established a garment factory in the apparel SEZ in Surat in 2007 and 8. In spite of our efforts till date over the last let's say from 2007 to now, or 2024, in the last 15-16 years, the capacity utilization in the SEZ has been below par due to seasonal export demand. To get the advantage of both the domestic market and exports, we have now got permission to exit the SEZ scheme and transition the Surat unit into a domestic tariff area by denotifying the SEZ plot. This will enable the company to cater from all our garment units, both to domestic and international, averaging the supply and demand, and being able to utilize the capacities in a better way. We have inquiries and orders flowing in for our garment division. The order book looks good, and we are confident of completing existing orders on time and continuing to get new orders. Now let's move to the financial performance for the quarter ended 9 months on December 24. Our total income increased by 11.5% to rupees 341 crores in quarter 3 FY25 on a year-on-year basis. This growth was primarily on the back of a strong growth of 32% year-on-year in the fabric business, coupled with continued traction in the garments vertical. For the 9 months of FY25, the total income amounted to 960.9 crores, an increase of 3.3% overall as compared with the same period last year. The EBITDA stood at 36.5 crores and rupees 85.7 crore during quarter 3 FY25 and 9 months FY25 respectively. The EBITDA margin in quarter 3 FY25 stood at 10.7%. This is an improvement over year-on-year and quarter-on-quarter. Profit before depreciation and tax came in at 25.6 crores for the quarter 3 FY25, and for the 9 months FY25 it stood at 57.4 crores. We reported a profit after tax of 10.2 crores for quarter 3 FY25 and a growth of 18.9% year-on-year, and rupees 16.3 crores for 9 months FY25. Looking ahead, we see the industry outlook as improving, and quarter 3 has already shown the trend. Speaking of each of the divisions, the yarn division witnessed a 5% decline in quarter 3 FY25 against quarter 3 FY24 to rupees 113 crores. In the 9 months of FY25, there was a 12% revenue dip in the yarn division as compared to the same period last year. The capacity utilization in the yarn division stood at 79% for the quarter 3. The decline is mainly attributed to subdued demand in the domestic market. The fabric segment has emerged as a standout performer with a boost in production during quarter 3 and a notable surge in exports to key markets. In quarter 3 FY25, the fabric division saw a revenue growth of 32% as compared with the last year and 15% as compared to the last quarter, and reached rupees 151 crore for the quarter. In the 9 months of FY25, there is a growth of 22% in the fabric business as compared to the 9 months of FY24. The capacity utilization in the fabric vertical stood at 79% for quarter 3, which has also improved as compared to the same period last year. And lastly, the garment business. For the quarter 3 FY25, the revenue for the garment division was up 8% year-on-year and down by 15% on the quarter-on-quarter to rupees 70 crore. The garment division in the 9 months of FY25 saw a marginal growth of 1% in revenue as compared to the 9 months of FY24, which was 207 crore. The capacity utilization in the garment vertical stood at 41% for the quarter 3 FY25. This is low, but it is because of the shifting that we were doing from our SEZ into the DTA. We are seeing a positive surge in inquiries now from both existing and new clients, and the current capacities are fully utilized. The production of jackets has increased as compared to trousers during this quarter. The overall revenue in the past quarter was impacted by lower capacity utilization due to the transition of our manufacturing facility in Surat, as I mentioned previously. In conclusion, the overall performance in quarter 3 has laid a foundation for the sustained growth that we wish to target going ahead. The recent challenges faced by the Bangladesh industry as well as the China Plus One factor continue to be a tailwind for India. And retailers are increasingly interested in partnering with vertically integrated company like ours. This positions us to steadily capitalize on the opportunities, enhance our market presence to support consistent growth. Thank you for your patience, and I would like to now open the floor for questions and answers. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Karan Mehra from Mehta Investments. Please go ahead.
Hello, sir. Good afternoon. Thank you for the opportunity and congratulations on good quarter three. Couple of questions. First being, the company has proposed exiting the special economic zone scheme and transitioning the Surat unit into a domestic tariff area to enhance the utilization. So if you can elaborate on the key benefits which is expected from this move and its impact on the overall production efficiency. Also, additionally, will there be any loss of capacity during this transition? If you can throw some light here, would be helpful.
Right. Thank you, Karan. Yes, you're right. There will be some impact on the capacity, which we already experienced in quarter three, because when we are making the transition, we have to move the machines, and we have temporarily hired a shed of 25,000 square foot in Surat, moved some of the machines there, and moved some of the machines to Daman, having lost that capacity for a while. So we will lose capacity for about a quarter or so before the capacity is utilized in a DTA across both Daman and Surat. So whatever capacity we had last year will now be able to be used across either export or domestic wherever demand is greater. That flexibility will allow the capacity utilization to be constant throughout the year in a better way, because we are averaging both export demand and domestic demand with the entire capacity. So this is going to be definitely very useful. Sometimes the cycle of the market is such that export demand is very good and domestic is low, and domestic is very low and export is good. So both these cycles will be averaged out, and if both demands are good, then we are happy to expand capacities very quickly and even use outside capacities. I hope that answers your question. So we are now looking at, in fact, in our garment business, a 20% growth year on year going forward for the next 2-3 years without adding any more capacity.
Understood, sir. Sir, that is helpful. Sir, my second question was on domestic and international, but you have answered. So if I'm having further questions, I will join back the queue. Thank you.
Thank you.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Darshika Khenka from AV FinCorp. Please go ahead.
Hello.
Darshika, you're not audible.
Last time around,
Hello,
our
Darshika.
yarn division was impacted, and you had highlighted that we are almost bottoming out in terms of the margins of yarn segment were concerned. But you also mentioned that the fabric and the garment division margins may not be able to compensate for the loss of the yarn segment. Now that we are more optimistic about our garment segment with the shift in the facility, also our quarterly margins have been more promising this time around. Do we see that change in the year coming ahead? And what is the outlook on the margin?
Okay, Darshika, that's a good question. I do recall saying that for the whole year, since the first half of the year, the margins were low across all three segments, we would not be able to compensate that in the yearly profit. Right? That remains true. although our quarter 3 has been better than the quarter 3 of last year, and we expect quarter 4 also to be better than the quarter 4 of last year, the H2 results will not be able to compensate the H1 poor performance for the whole year as a whole. But, however, going by this trend of what has happened now in quarter 3 and what we expect in quarter 4, this trend we expect to continue. We will do better than the last FY24 in the coming year 25-26. So I hope that answers your broad question. We do see that both the fabric business and the garment business is going to be a bigger percentage of our overall business and turnover. So if today the fabric and the garment business is about 65% of our total turnover in the quarter 3, roughly, we do expect that we can increase the percentage of our fabric and garment business to be even 70% of our turnover. And as that happens, we will be in a position where we can compensate any margin losses in the yarn business and garment business going forward. As a percentage of our turnover, that will not matter so much, the yarn business.
Okay. Would you be able to quote a number in terms of the guidance for margins?
No, I mean, numbers are difficult to give you, but the trend is encouraging.
Would we be able to reach FY23 levels? That's like 13% short. Is the situation...
We've seen an EBITDA level of, I think, 11.7% almost in quarter 3. And quarter 4, we expect to do more or less the same, or, we'll see what it comes to, but we are expecting it to be more or less the same. Going forward for the next financial year, we are targeting at least an EBITDA level overall, with both garment chipping in very well since the restructuring has been done. Fabric growing, we expect the EBITDA level overall, regardless of what happens to the yarn market, to be at least 12%.
Thank you so much. This was really helpful. That's it.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Harsh Doshi from Analyze India. Please go ahead.
Good morning, sir.
Morning.
I wanted to know what are the capex plan for next 2 to 3 years?
Right. Our capex plan for the next year is about 50 crores.
In plant and machinery.
In plant and machinery alone, out of which we are expecting to invest about 45 crores into fabric business, 3 crores or so in the yarn balancing and modernization, and about 2 crores in garment. Other than that, Kavita will elaborate.
Other than that, we will have some other capex also, like as we were saying in our earlier call also. Since the mill is going to be a 50-year-old mill, we will need some kind of infrastructure facilities to be recreated, upgraded, and realign certain processes and all that. So that will be also some capex. So overall, if we look at in the next year, we are looking at a capex of around 80 to 100 CR, all put together. But it will get into the phase manner.
So some of it will be in
power. It
some
will
be in civil infrastructure.
The new
and environmental enhancements.
Yes.
Yeah.
Okay. So when do we move towards the debt reduction journey, sir?
So, we are already not investing more than we can generate, and we are expecting, like, say, a 12% EBITDA generation and a growth of at least about 15% year on year. I mean, like, we are talking about the fabric and the garment business growing at 20% annually, compounded over the next few years. And we are talking about a journey where the yarn business at least should remain flat, because internal consumptions will increase. Whatever investments we are making in the yarn business will only help us to enhance our verticality and be able to generate more EBITDA margins in the fabric and garment business. So this generation of cash that we have and what we are spending on the infrastructure improvements and on modernization, the amount we are spending is much less. And this will allow us to continue this journey as we improve our ability to even use other infrastructures available in the country of capacities. So we are saying that our own capacity utilization is already not too good right now. We will complete and use all of our capacities and endeavor to use even outside capacities. As that happens, we will be able to pay off the debt and we will start to return money. So, if you see if we get to like maybe about 1,500 crore plus turnover and we are earning at 12%, you'll begin to see the return going back of the debt.
Got it. So right now, do we assume that we are at the peak debt?
Yes. I mean, by say mid of next year, we will be at the peak of the debt, and then year after that, as we had planned this kind of entire growth journey, then the debt reduction will start.
Understood. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Dhruv Modi from DSM Securities. Please go ahead.
Good afternoon, sir, and a very congratulations on good set of numbers. So I have a couple of questions. First question being, with the ongoing unrest like situation in Bangladesh, we are seeing a shift in sourcing strategies similar to earlier China plus one trade. Which geographies do you believe stand to benefit the most from situations like this? And additionally, how do you see India positioning itself in this evolving global supply chain?
Yeah. Thank you, Dhruv. Thank you for your encouragement. And as far as answering your question is concerned, when you see the shift happening from Bangladesh to India, the demand and order book position that we have currently will be very good. And we are seeing that. In fact, we are having to say no to a lot of orders right now because we don't have the capacities available due to this shifting part. But even if we assume that all of our capacities get started, we will still fall short of capacity in the garmenting when demand is concerned. The challenge is going to be margin. And for margin, we have to decide which countries are better for us than others. India does not have trade pacts with Europe. And therefore, we are at a disadvantage as compared both to Sri Lanka and Bangladesh in dealing with Europe in terms of the duties applicable to our garments entering their countries. This is why our focus will be more on the US market. And in the US market, we expect whatever the Trumpian idea is about tariffs, we think that this is more bluster than it is going to be actuality. And in the garment area, the competition against China and the shift to the US market for packages going out of India as a vertical supplier, this will increase. We expect this to be the biggest growth area. Other than that, if any FTA happens with the UK, that will be another boost. If anything happens with Europe, that will be a bonus. But generally speaking, the US is the largest market in the world, and we do expect the growth between India and US to be a big driver of export performance.
Okay. And my second question is, are there any retailers showing signs of increased demand for the upcoming spring season? And furthermore, how is Q4 demand shaping up, especially with the impact of the wedding season and the upcoming Eid festival?
Yeah, so let's separate the two markets, the domestic and the export. If we speak about the domestic market, the demand has been subdued in general, even across the last Diwali and the whole wedding season, the last wedding season, it wasn't great at all. And this still, we did manage growth within that in our fabric business. And in our garment business, we got marginal growth. So even though demand was subdued, we have managed to grow in a subdued demand market situation, because there is a macro part and there is a part where we are substituting what was being imported from China in a very efficient way now. So we are still seeing that the growth will happen for us in the domestic market, regardless of how the overall market is performing, because it is a growth which is fueled by the fact that we are encouraging people not to import and giving them products that are as good with better value within India itself. So I see that that market will also continue to be good driver both in the garment as well as in the export, the domestic part. As far as exports is concerned, we do have a good tailwind in terms of sentiment. In terms of the fact that we actually conclude the deals, it is about margin. Having to compete on the margin and get the business, that is the challenge. So at this moment, even at a lower margin, we are trying to corner more businesses, hoping that eventually the margin will come. This is why the margin can be sometimes a challenge in our garment business. This is not a question of the order book. It is a question of the margin.
Okay. Thank you for your brief answer, sir, and all the best for the current quarter.
Thank you.
Thank you. Next question is from the line of Randeep Kapoor from InvestI Investments. Please go ahead.
Yeah, hi, sir. Sir, my question regarding when you converted your SEZ unit to a domestic unit, so will there be any financial implication of foregoing some tax concession?
Yes, there will be some. I'll let Kavita answer exactly what.
See what happens, yes. With the GST coming in and with the export benefits, what you get, the incentives back, that gets neutralized in a way. So there will not be much of a financial loss as such, we are not going to lose any benefit because we will be moving into the DTS. Having said that, also because we will be able to balance our capacity utilization much better, so on an overall basis, it will be more beneficial for us to get into that, because then we will be catering to both the market and we will be able to service much faster to the customers.
Okay, so apart from that, also just to add, Ranveer, that we will, when we are moving away from the SEZ into DTA, get for the export part of DTA better total incentives for export than we get in the SEZ. In the SEZ, we are importing all of the things, all of the fabric and trims, etc., zero duty, and exporting the garment out with zero incentives. Whereas when we are exporting the garment from a DTA, the overall incentives increase by about 3 to 4%.
Okay, so overall positive.
Overall positive, yes.
Okay, thank you so much, sir.
That is the reason to move, in spite of the pain.
Yeah, I understand that. Thank you, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Ravi Shah from BRS Capital Solutions. Please go ahead.
Hi, sir. Am I audible?
Yes, please go ahead.
Yeah. So basically, sir, my first question is that regarding the employee cost, so the improvement in EBITDA primarily seems driven by this a reduction in employee expenses due to absenteeism of the workers during Diwali period. So how should we see our sustainable EBITDA margins, and will our cost, employee cost, be revised? How will it work?
No, Ravi, it's not true that the margin has been driven by employee cost reduction at all. In fact, our gross margin has improved. And our gross margin has improved not because of the employee cost reduction. That employee cost reduction is only because it has in fact contributed to a reduction in turnover and the underutilization of our capacities in the spinning division. So that has been a loss for us. We have not been able to utilize our full capacity and sell in the yarn division, where the main loss of where the labor has not arrived. So this is something which was peculiar to a period when we were going into a modernization phase. So partly we were losing capacity and not putting in the labor because of the machines being modernized. And same thing was also happening at Surat. So you had workers which we were not employing because the machines were not available for them.
Understood, sir. Thank you, sir, for the detailed answer. So my second question would be on our growth. So basically, the fabric and the garment segment have witnessed very good growth. So what kind of growth trajectory should we expect going forward, and what are the demand trends right now within these segments as of today?
Yeah, I explained this earlier and I answered it also, that we are expecting growth within the fabric division of 20% going forward year on year, and about similar growth in the garment business. Yarn business, we at the moment are thinking will be more flat, but more internal consumption of yarn will happen to drive the fabric business and the garment business, which will also be supported by external yarn buying and external fabric buying. So overall, we are looking at maybe 60, 65, 70% of our turnover coming from the garment and the fabric business, and the rest coming from yarn, with growth happening in both of these, fabric and garment, at about 20%.
Understood, sir. Thank you. And so my last question would be regarding Trump. So basically, now he's taken charge. So have you seen any encouraging shift in demand from the US market as of now?
There's a lot of demand, and a particular price they are willing to buy out all the capacity we have for a long time. But we are not ready to accept it. There are negotiations going on, and we are looking at which particular buyers to tie up with long term that will help our profitability.
Understood, sir. Thank you so much for detailed answers, and all the best, sir.
Thank you.
Thank you very much. Next question is from the line of Sanjeev Damani from SKD Consultants. Please go ahead.
Namaskar, sir. Actually, I just became curious to know whether the SEZ was also a owned property, and we have facilities in Daman and Silvassa both. So they were existing facilities, or we have taken something new, and that too, have we bought them out, or it is on some rental basis? Can I know, sir?
Yeah, so the Daman properties are all owned by us, and the SEZ was also, it was leased by the leased from the GIDC.
Right.
By Banswara.
Right.
So that, yeah.
So that lease is as good as a ownership. When we leave it, would we be gaining something?
Yeah, so that whole area, once it's denotified, will become a part of the DTA, and the operations will continue in that same land.
Acha, okay.
But it will happen under DTA.
But sir, you said that you are shifting the machine from there.
That is in the interim period. Because in the interim period, where it takes 3 months to 4 months for them to give us permissions to be able to shut down the DTA, shut down the SEZ and move it to DTA, during that period to not lose the entire productivity, we have moved into rental shed, or we have moved partly into Daman. But we have not been able to...
Which is owned by us only. So the place, that existing place of Surat will remain with us, and tomorrow when it got into DTA, we can think of utilizing the same shades and things for our manufacturing.
Absolutely.
So in Surat, we only make garments, or we make fabric as well, sir?
Only garments.
Only garments we make. Okay. Sir, you had indicated earlier also in last call that you are looking forward to good growth in the garment market, because you have also tied up with a lot of modern retail outlet of India. Can you name them who are our buyers in India, like Stans or like Trent or Judio?
Yeah.
Or...
If you look at our investor presentation, which we have uploaded, we have given a full list of the buyers. We have given a full list, so please have a look on the website.
Yes.
yes, Trent is one of our customers, just to answer that question of yours. And I mean, we have all of the Arrow, Van Heusen, the entire Alan Solly, many of the retailers in India, and as well as Myntra and Flipkart to some extent. So all of that is happening right now. We have a full list of domestic clients in our page 21 of what we have uploaded on the website.
One more question, sir. Do we also make woolen yarns and worsted suitings as well, or we only make polyester products? And because you last time told us that you are not making any cotton yarns. Am I right, sir?
Cotton, we do not do yarns. That's true. We do not make cotton yarns. We buy cotton yarns from outside. As far as woolen yarns are concerned, we make worsted yarns. And we do have a worsted spinning capacity. We produce about 100-120 tons of worsted yarn every month.
And which goes into our own manufacturing of fabric.
Correct. It is for self-consumption only. And it goes entirely into our fabric business. It also supports our brands of Simone and Federico, which are two brands we have introduced into the country with a distribution network, and they are growing well.
Thank you very much, sir, and all the best. Looking forward to great growth of Banswara Syntex in the coming days. Thank you,
sir. Thank you.
Thank you very much. Next question is from Atul Daga from Daga Securities. Please go ahead.
Hello? Hello? Yes, am I audible?
Yes, go ahead.
Hi, sir. Sir, just throw some light on how is the modernization of machinery progressing, and when do you expect capacity utilization in the yarn division to normalize?
So we're expecting by quarter one of the next financial year, everything will be gung-ho and going well in the yarn division. The modernization will help us not only to get increased productivity per employee, but also improve the value-added yarns we make, both for internal consumption and external sale.
Okay. That helps. Sir, also with the challenges in Bangladesh textile industry, Indian players are seeing, increased interest from global retailers. So, have you benefited from these new client acquisitions or higher order volumes?
We are experiencing a higher order inquiries that we are unable to conclude because of margin pressures. But so I can't say we have really benefited yet. The only benefit is that the order flows are more.
Okay. I asked because as a vertically integrated player, how do you plan to capitalize on this shift in global sourcing trends?
Yeah, so we are in the best position to capitalize on it, being a vertical player, and we want to use our verticality to be able to, leverage that position. There are buyers who are willing to commit, but they want to commit at the same price that they would be buying from Bangladesh. And they have duty advantages which are coming from Bangladesh, and they want all of those advantages to get the same landed duty paid price as they would get from India, as they would get from Bangladesh from India. That we are not able to match without sacrificing margins.
Okay.
Challenge.
Sir, also one last question. Any updates you can throw on Simone brand front?
On what? The Simone brand. Yeah.
Yes.
So the Simone brand we have launched about 6 to 7 months ago. We've gone through one season where the wedding season and the Indian market was not as great as we expected. So we've only been able to do about 8 to 10 crores of turnover so far. Maybe we'll close the year at about 15 crores. Our original target was 25. So it's been less than expected for this year in the Simone brand. But it's not, really disappointing because most brands have had 50% less sales in the domestic market in over-the-counter fabric, like Raymond's or Reed & Taylor or J. Hampstead. Everybody has suffered on this front. Next year we expect, with our distribution network in place and the fact that we have been able to replicate many of the imported Chinese fabrics in Simone, our demand will be better.
Okay. That helps. Thank you so much, sir. All the best.
Thank you.
Thank you very much. A reminder to all the participants, you may press star and one to ask a question. As there are no further questions, I'll now hand the conference over to Mr. Ravindra Kumar Toshniwal for closing comments.
Thank you. Thank you, everyone, for listening in and for your support of Banswara. In the textile industry, we are in a unique position as a vertical mill of man-mades and woolen worsted fabrics. With our finishing and with our garmenting and our specialty yarn support, we are in a position to be able to capture a large portion of the interest that is coming to India, both because of the China Plus and the situation of the geopolitical problems in Bangladesh. We have learned over the years how to produce the yarns that China is making. We are now, with the modernization, going to be able to produce them at a price which is very similar to China. And in spite of the raw material prices in India being higher, we think that when we are talking about fabric and garment in man-mades, we will be able to compete very effectively and replace China for many of our buyers. The market is so large that our capacities are eventually going to fall short. And then we will look forward to be able to utilize underutilized capacities within the country and think about a much bigger greenfield expansion. So we are looking forward to continue to work towards this and see that the next 8 to 10 years of where man-mades can go from India to the global supply chain, we are a key player in that. And look forward to be able to interact with you all and continue the learning towards this journey. Thank you very much.
Thank you very much. On behalf of BanswaraSyntex Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.